Welcome, ladies and gentlemen. My name is Peter Youssef. I'm the senior analyst of IronFX. Together we'll be going through a small discussion about the week ahead, mainly in the FX markets. However, some comments about the US stock markets and gold are going to be made as well as for oil. Before we start though, I have to note that there's a clear risk warning. Our products are traded on a margin and carry a high level of risk, and thus it's possible to lose all your capital. Now, these products may not be suitable for everyone, and you should ensure that you understand the risks involved before trading. Also, as a disclaimer, the information in this webinar should not be considered as an investment advice or investment recommendation, but instead as educational material only. This material is just the personal opinion of the author, and clients' investment objective and risks tolerance are not being considered here. IronFX is not responsible for any loss arising from any information herein contained. Now, moving to the week ahead, and before we start, well, it's been a rather quiet week with the exception of the release of the US CPI rates for January yesterday. On the other hand, US stock markets tended to present higher volatility, mostly due to the earnings season that generated a high number of headlines and captured the interest of traders. In the coming week, we are about to get more high-impact financial releases. Hence, we make a start on a slow Monday with no major financial data being expected. Yet on Tuesday, we get Japan's GDP rates for Q4 2020. As well as Germany's ZEW Indicators for February. On Wednesday, we note the release of the US retail sales growth rate for January, as well as Canada's CPI rates for the same month. On Thursday, we note Australia's employment data for January, as well as the weekly US initial jobless claims figure. And on Friday, we get Japan's CPI rates for January, as well as Canada's retail sales growth rate for December. On the monetary level, we highlight the release of the Fed's minutes for the January meeting on Wednesday. And on second note, we would also like to mention the release of RBA's meeting minutes for February on Tuesday, as well as the Central Bank of Turkey's interest rate decision, that's on Thursday. Moving now to the US dollar, and this would be USD indexes for our chart. And a clear upward movement yesterday as the index broke the 95.60. Actually, at some point aiming even for the 96.55, yet seems to be stabilizing between the two levels. Nevertheless, the upward boundary of the past sideways movement has been broken, so we tend to maintain a rather bullish outlook for the USD currently, despite a correction being performed right now. Overall, we would like to note as resistance levels the 96.15, which provided some resistance here. However, was mainly used as a support line back here, and as the price action now is lower, has been turned into a resistance line. Higher than that would be the 96.65 and even higher than 97.15. To the downside, besides the 95.60, which was a resistance line and now has been turned also as a support line, which actually provided some support twice here. We also note the 95 level and the 94.60. Now moving to USD's fundamentals. Now market worries remain on the Fed's intentions. Some Fed policymakers hope for a slowdown of inflationary pressures in the coming months. It's characteristic that Atlanta Fed President Bostic is reported to have stated that there is some evidence that we are on the cusp of inflationary pressures and that they could weaken in the coming months. On the other hand, after the release of January's CPI rates, St. Louis Fed President Bullard, in an interview yesterday, supported the idea of a full point rate hike by July, as the inflationary shock, quote unquote, requires a big response in his view, which is a quite hawkish view in our opinion. Hence, the market may have hawkish expectations from the Fed at this point. Now, the release of the US CPI rates for January once again highlighted the inflationary pressures in the US economy, as the year-on-year rate reached a new 30-year high and turned the screw on the Fed to act in a more aggressive hawkish way in regards of its monetary policy. That's why we highlight the release of the Fed's January meeting minutes. That's on Wednesday, remember. We expect the document to be scrutinized by analysts and other market participants. Now, should the comments made by the Fed's policymakers actually support the market's hawkish expectations, we may see the greenback being supported and vice versa. At this point, we would like to point out that US yields were on the rise this week, reaching a 2-year high at some point yesterday, and should this tendency actually continue in the coming week, we may see the USD getting some support. As for financial releases, we make a start on Tuesday with the release of January's PPI rates as well as the New York Fed manufacturing indicator. On Wednesday, we get the US retail sales. You can see the chart on your screen. Note the wide drop, the decline into the negatives, which was recorded practically for the month of December at minus 1.9% month on month. And the big question is whether practically US retail sales are going to be showing some growth once again, i.e. turning into a positive rate and implying that the average US consumer is going to be able to spend more and willing to spend more in the US economy as such. At the same day though, we also get the industrial production growth rate also being for January, which covers practically the economic activity on the production side as well. Now on Thursday we get January's construction data, the weekly initial jobless claims figure, as well as the Philly Fed Business Index for February, and finally on Friday we get the existing home sales figure for January. Moving now to the pound, and this would be cables for our chart. In a sideways motion despite a small outburst yesterday to the upside, it was quickly corrected lower, and practically the pair remained in the sideways motion just below the 1.36 resistance line. Another support line could be formed here, however we opted directly for the 1.3430. Lower than that would be the 1.3275 and even lower the 1.3135. To the upside, besides the 1.36, which actually provided quite some considerable resistance here, we note the 1.3720 and even higher the 1.3830. Moving now to the pound's fundamentals. On the fundamental side, we note that the instability in the UK political scene as the pressure on PM Johnson to resign increases over the Partygate practically could be somewhat bearish for the pound. On the other hand though, we did not see any bullish reactions for the pound in regards to the UK government's intentions to lift COVID-related restrictions, while also supportive for the pound could be reports stating that inflation and a shortage of workers in the UK are pushing salaries higher in January, as was discussed by BoE. Now on the monetary level, BoE chief economist Hugh Pill's comments that he would prefer a steady-handed approach in regards to the tightening of the monetary policy could moderate the market's hawkish expectations regarding the BoE. Also, we must note that BoE Governor Bailey yesterday actually attacked Brussels and the EU over intentions to cut the city clearing houses off from European banks, which was a painful reminder of the possible consequences for the UK economy of Brexit. As for financial releases, we note on Tuesday the release of UK's employment data for December, while on Wednesday we get UK CPI rates for January, which you can see the chart on your screen right now. In the red line you get the year-on-year CPI rate, the year-on-year headline CPI rate, which is constantly accelerating practically, and that's been since around February 2021. Maybe a small pause here and here, but overall the direction is clearly to the upside. We should note that the headline CPI rate on a year-on-year level is already at a 20-year high, and further acceleration could push BoE into picking up the pace of the tightening of its monetary policy. Now, ending the week on Friday, we note the release of UK's retail sales for January. Moving now to the JPY, and this would be USD JPY's 4-hour chart. Now, despite an upward movement, which was characterized since around the early February, we see that there is a small capping and some resistance at the 116.30 level, which provided resistance once again back around the beginning of January and actually pushed the price action lower. Overall, there could be a wide sideways movement between the 116.30 and the 113.70. But once again, we tend to maintain a bias to the upside, given also that the RSI indicator is at the reading of 70, implying a rather bullish sentiment of the market. Should that come into play, we would expect the pair to actually break above 116.30 and start aiming for the 117.50. Higher than that would be the 118.40. To the downside, and should the bears actually say enough is enough and take over, we may see the pair reversing course, aiming initially for the 115.45. Lower than that would be the 114.45, and even lower would be the 113.70, which actually is the lowest level in our chart. Moving now to JPY's fundamentals. Now, the Japanese economy seems to be recovering, as it shows clearer signs in picking up pace. The pace of recovery could be expedited further should the impact of the pandemic and supply constraints, including microchips, gradually subside. Also, inflation remains elevated if compared to past rates, and BOJ's ultra-loose monetary policy is exactly pushing for such a scenario. On a monetary level, we would expect BOJ to maintain its ultra-loose monetary policy until inflation reaches the bank's 2% target. Also interesting to note would be BOJ board member Nakamura's comments that stable exchange rates of the JPY against the USD could be good for the Japanese economy. On the other hand, due to its dual nature, we would expect the JPY to remain driven by safe haven flows in the coming week. Nevertheless, we would also like to highlight the release of Japan's GDP rate for Q4 2021 on Tuesday, and you can see the chart in your screen right now. Note that we're talking about the GDP quarter rate on an annualized basis, and note how it was in the negatives for Q3. Overall, an acceleration could be expected, in which case we may see practically JPY getting some support. Other than that, on Thursday we would like to note also the release of December's machinery orders growth rate, as well as January's trade data, while on Friday we get from Japan the release of the CPI rates for January. Moving now to the common currency, and this would be Euro USD's 4-hour chart. In a downward motion since yesterday, practically with the release of the US CPI rates. The pair has been aiming and actually almost tested the 1.1370 during today's early European session. We note this as a possible support line, as it was a resistance line back here. And here. Even lower than that would note also the 1.13, which provided support a couple of times in the back. And even lower than that would be the 1.1235. To the upside, we note the 1.1435, a resistance line which was valid here. And higher than that would be the 1.1482, which actually served the pair pretty well as a resistance line once, twice, and even higher as an ultimate target for the bulls would be the 1.1545. Moving now to the euro's fundamentals. Now, fundamentals related to the euro could not exclude at this stage also the crisis in the Ukraine, as the tensions in the relationships with Russia seem to weigh on the common currency, mainly due to the market worries regarding the European dependency on Russian fuel, whether that is gas or oil. Europeans seem to try to show a unified front against the Russians, yet despite the German Chancellor Scholz's visit in the US recently, the German side seems to maintain its doubts about the whole situation. Now, French President Macron, on the other hand, paid a visit to Moscow, yet with little results. On the monetary front, despite ECB's hawkish tone in its last interest rate decision, ECB President Lagarde, in statements she made on Monday, signaled a gradual shift in ECB monetary policy to curb inflationary pressures in the area. ECB President's worries became more clear yesterday, as she practically issued a warning against tightening the monetary policy too fast with possible hasty rate hikes, as they may not tackle the inflation issue and could endanger the recovery of Eurozone's economy. Now, we perceive the statements as further signs of hesitation on behalf of the ECB, which could weaken the common currency. It should be noted, though, that despite ECB's chief economist Lane substantially supporting the bank's projections, more central bank governors in the Eurozone seem to be losing faith in the bank's forecasting system and seem to even turn more hawkish. As for financial releases, we note on Tuesday the release of Germany's ZEW Indicators for February. You can see the relative chart in your screens right now. In the green line, practically the economic sentiments indicator is being depicted with an expectation for the overall outlook to improve, but in the yellow line we can see that the current conditions are deteriorating, which is a negative. Nevertheless, besides German ZEW indicators, which show the tendencies for the largest economy in the Eurozone, we would also like to note Eurozone's revised GDP rate for quarter 4. And on Friday we get France's final CPI EU normalized rate for January, as well as Eurozone's preliminary consumer confidence indicator for February. Moving now to the Australian currency, Australian dollar, against the USD in this chart in a clear downward motion, as the pair practically yesterday broke below the 0.7170 and started to aim actually for the 0.71. Nevertheless, the Aussie is about to end the week higher against the USD, as practically the beginning of the week was at an even lower level. So despite the upward trend line being broken, clearly broken in the 4-hour chart, we tend to see that the AUD is about to end the week in the greens against the USD. For the time being, we still maintain a bearish outlook. However, there are some signs of stabilization. Note the correction higher during today's European session, as well as that the RSI indicator below the 4-hour chart has remained near the reading of 50, implying a more indecisive market. To the downside, we note the 0.71. Lower than that would be the 0.50, providing support here, as well as here. And even lower would be the 0.6995. To the upside, we note the 0.7170, the 0.7230, and the highest level noted for the bulls could be the 0.7275 with a big stop here. Moving now to the Aussie's fundamentals. Now, it should be noted that the drop of AUD against the USD yesterday actually coincided also with the stopping of bond purchases by the RBA. So the Reserve Bank of Australia was reported to practically end its QE program on Thursday after purchasing around 350 billion Australian dollars as part of bond buying program of considerable size. Now, the buying spree of the bank is estimated, as reported by Reuters at least, to have kept bond yields around 30 basis points lower. So some rise of Australian bond yields could be expected, yet in our opinion disruption is expected to be low or minimal as the market rebalances. On the monetary front, we would also note RBA Governor Lowe's comments yesterday that he could be prepared to tolerate inflation above the upper end of RBA's inflation target range, which is 3%. And the statement underscored the bank's dovish stance. Also on the monetary front, we would note the release of RBA's February meeting minutes, and should the document actually show that the bank maintains its hesitations to bring earlier any rate hikes, we may see the Aussie slipping on Tuesday's Asian session. On a more fundamental level, we expect the market mood to sway the commodity currency AUD, as should there be a more risk-on attitude observed in the markets, we may see the Aussie getting some tailwinds, and then the opposite could occur. Then market mood may be more cautious and thus weaken the Aussie. As for financial releases, we would like to highlight the release of Australia's employment data for January, that's on Thursday. And should the data show that the Australian employment market has tightened by a rise in the employment change figure and or a drop of the unemployment rate, we may see the Aussie getting some support, as it could provide more confidence to RBA. Please note that December's data were not so encouraging, given that, okay, on the one hand, the unemployment rate dropped, but also did the employment change figure, and that tended to create some worries among Aussie investors. Now, the day before that, on Wednesday that is, we would also like to note the release of China's inflation rates for January. Moving now to the CAD, and this would be the CADs for our chart, USD CADs for our chart, in a sideways motion, the pair is, and it seems about to end the week where it began. We tend to highlight the 1.2785 as a resistance line, and then that's to be followed by the 1.2855. Higher than that would be, and the ultimate bullish scenario would be the 1.2945. To the downside, we initially note the 1.2695, lower than that the 1.2585, and even lower than that would be the 1.2495. Note that the RSI indicator below the 4-hour chart remains between the readings of 50 and 70, implying a small advantage for the bulls. Moving now to the CAD's fundamentals. On the monetary front, we note BoC Governor Tiff McClellan's comments, who was reported to have stated that the current rate of inflation is too high, which for some may have implied that BoC could be about tightening its monetary policy. It should be noted that the market is currently fully pricing in a 25 basis points rate hike in the early March meeting, while it also seems to be pricing in more rate hikes to come by the end of the year, currently at least. So overall, the market's monetary expectations could be providing some support for the loonie should they remain tilted to the hawkish side. On a more fundamental level, we note that WTI's price has hit a high point just above $91 per barrel, yet corrected a bit lower yesterday and seems to be stabilizing somewhat today. Further advances of oil prices, though, could provide support for the CAD and vice versa, as commodity currency CAD is considered to have a positive correlation with oil prices due to the high amount produced of the commodity by Canada. Also on the loonies fundamentals, the recent blocking of the Ambassador Bridge in the US-Canadian border cannot pass unnoticed, indicative of the tensions in Canada's society about COVID-related restrictions. As for financial releases, we would like to note the release of Canada's house starts on an annualized basis for January and Tuesday. On Wednesday, we highlight the release of Canada's CPI rates, that's for January, and you can see the chart in front of your screens. So practically you can see the acceleration noted on the year-on-year level for December, while practically the December month-on-month rate was nearing zero. As a more cautious comment, should the CPI rates actually accelerate further in January, we may see the CAD getting some support, as they would be adding pressure on the BoC to act in regards of tightening its monetary policy. Finally, on Friday, we get Canada's retail sales growth rate, and that's for December. Now, before we leave you, and as a general comment, overall in the coming week, we may see the USD regaining some of the initiative, especially given the release of January's US CPI rates yesterday, which intensifies the interest around the Fed's intentions. Nevertheless, a number of financial releases could turn the spotlight on other currencies during the week, thus creating a more balanced blend of trading opportunities for traders. Now, the significance of the US CPI release yesterday was highlighted as its ripple effects extended beyond the FX market. US stock markets ended the day in the reds yesterday as investors were spooked by the possibility of the Fed hiking rates at a faster pace. Also, gold recorded losses for the day, relenting its role as a hedging instrument against inflation and succumbed to the strengthening of the USD, while the rise of US yields tended to intensify gold's losses. On the monetary level, we would like to make a small comment about the Central Bank of Turkey interest rate decision. That's on Thursday. It should be noted that before year's end, the bank had stated that the first months of 2022 would be significant in regards to inflationary pressures. Mind you that CBT had lower rates somewhat aggressively in 2021, yet the main issue remains inflation for the Turkish economy. CPI rates in January slowed down a bit on a month-on-month basis, yet accelerated to 48.69% on a year-on-year level, underscoring the issue. In its last meeting, CBT had kept the weekly repo rate at 14%, and should the bank remain on hold on this meeting as well, market attention could be turned towards any further guidance the bank may provide. Now, should the Central Bank of Turkey actually hint towards more easing of its monetary policy in the future, we may see the TRY weakening substantially. That should sum it up for the week. From all of us here at IronFX, thank you for watching and best wishes for solid trading.